3, 2, 1, bananas. So you thought I was going to do 3, 2, 1, boom, or 3, 2, 1, go. Well, not quite. See, today's a bit different. And a bit like my boys that I coach when they're on the line and they're about to do some fast feet exercises, might be on their toes, and I go 3, 2, 1. Oh no, hold steady, wait, patience, on your toes, get ready to react. 3, 2, 1, bananas. No, I told you wait. 3, 2, 1, go. Okay, now you're off. And now we're off. Welcome to Elk Radio. My name's Ian Kebblewhite. And today we're going to talk about one of the incoming questions we had from our member. Member's name was Ben, and I want to thank him for that very fine question you've presented. The question was, what are people missing when it comes to coronavirus and their finances? So short-term problem versus long-term planning. Great question. So what I think that comes down to, when I get to the bottom of what that question's about, I think it comes down to whether people are seeing moments for what they are, and if they're not, why not? And that comes down to a deeper level of consumer confidence. So consumer confidence and the sentiment and the trends and indeed the activities that don't or do occur as a result of that are what I think people are missing, in terms of there's no consumer confidence because they're perhaps not seeing moments for what they are. Then they're not taking the steps they need to, which in reality, this might be a short-term problem at the moment. It might very much become a medium-term or long-term issue we deal with, but it won't be a problem. It'll be a matter that a problem is simply something you don't have the answer for yet. That's the first thing. So we'll get an answer for this, and that answer may well be in the way that we have to continue to conduct our life going forward, but we're not going to stop. We're humans, we're Australians, and we do not stop moving forward. Now, look, there's some views on that maybe we should do things differently going forward for the protection of our beautiful planet and climate and all that, and we can thrash that out in another radio show, and that's something I'm passionate about, and that's where the name Elk comes from. Elk is about having something that's just instantly recognizable, beautiful, majestic, a creature that migrates and does things in numbers, and that's very much what elk is about, and that environmental sense. And so when I've got the antlers in my office, they're not taken from taking one of those beautiful animals down. They're about the fact that those fall off every year, and we're able to collect those, and they are part of an important feature of our office, what we stand for. And so back to the question, and the question involved the word coronavirus, and my 4-year-old Phoenix, he's so beautiful. He always finds the best way to describe things. He uses the most amazing words. Like, he's got a fascination with panthers at the moment. He's got a fascination with animals, dinosaurs. Like, he's hopefully going to be something like a Steve Irwin, someone that actually just brings so much joy, and he just loves what he does. Now, that's perhaps after being a footballer, of course. So with regards to Phoenix, he was watching something amongst the things that were going on in the house, and on the news it said something along the lines of COVID, and he goes, "No, it's not COVID, it's coronavirus," in his beautiful words and beautiful, that little bit of a speech that he's got. The sound, it was just an amazing thing to hear. And so I just thought I'd bring that up, because as soon as I heard coronavirus in that question, it made me think of that, my little Phoenix. And as I said, he's so observant and uses the most beautiful words, and he's got a fascination with animals, and that animal at the moment is a panther or a leopard. But for the panther, when he sees a panther, he goes, "That's so beautiful, Daddy." Like, he literally really thinks about what he's saying. And what I was talking about in terms of the start of, there's so much crap, or did I say that? Maybe it was in my head. There's just so much crap on social media, in Facebook and LinkedIn. And look, the Elk Radio is not about that. We have a genuine why. For a long time now, I've honestly believed that what we've got to say and what we do really should be heard by more people, one to many, by as many people as possible. And that's what our why is, and that's what we do, Elk Radio, not to give you more noise that just takes up your headspace. So we're going to look at focusing our topics and what we talk about to make it as of maximum value to you as possible, our valued members. And so that question in terms of what are people missing when it comes to coronavirus and their finances? I believe that it comes down to two critical points. People seeing moments for what they are, and also the consumer confidence they have. And that consumer confidence can be unfounded anxiety or uncertainty because they're not being informed or not seeing moments for what they are relevant to them, or related to very much the fact that they might be experiencing completely different weather to what someone may be experiencing that is less affected or unaffected, other than the fact they've got more time on their hands and spending their time telecommuting, which means they're working from home and they're doing a lot more type of things over the internet, phone, and email. So if you get into the bottom of it, if it comes down to seeing moments for what they are, then we've got two pathways to discuss here, don't we? We've got people that are in the boat, and they're in the boat and their weather is fine, and they're not experiencing any kind of financial hardship. Their employment's been unaffected, or if it has, it's been an adjustment more than a disadvantage or an effect, or a effect for the negative. And so they need to look at their circumstances and go, well, wait a second. Given what's happening in the financial, in the economy and in the financial marketplace, is this a great time to take stock? So do a stock take of what my current position is, and then look at what I can do to continue to get ahead. And what it may also be then is a time for people that haven't taken action before to take the massive action, or indeed the action, the steps needed to get ahead and maybe make up for some of that lost time. Because why I say that is, and you're going to hear this from me, rates are at record lows. It's as close to free money as you're ever going to get. Interest rates with a two in front, who would ever think it would get to that? Who would ever thought it would get to that? But yet here we are, where we can fix for medium term at 2% or thereabouts and borrow money to, one, lock in our home loan, the most expensive type of debt we've got, allowing us then to smash that debt and make best use of that income, the income we've got now. How can we use that effectively? So the savings you generate, that interest, going from a higher rate to a lower rate, will lock it in and put it to work by paying more for your principal more quickly. Or going, wait a second, what if I use some of that to pay for my principal and some of that to go, well, what if I invest that in something else? Put that to work for me in other ways. Because I can tell you what, I built Elk, not with a loan, not with borrowings, but with cash flow. By making every dollar work, every cent I earned, putting it to work for the benefit of being able to continually be in a robust and strong position. So we know all about how to grow your personal situation, how to grow a business by using cash flow and putting it to work. In actual fact, one of the most wealthiest people I've ever met, I had a lot of dealings with, built his wealth through savings, through cash, and built it to a significant fortune. So saving money, whilst that is not going to work for everyone, but certainly saving money and putting that money to work, the savings to work, to acquire assets or invest in other things, is something you need to look at. But if we go further down that pathway, so pathway one we've talked about, what you've got is a situation where that money being put to work to acquire an asset, for example, well, hold on a second. The rates on that kind of situation are also at record lows, in the twos. Well, what that means is if I can put that money to work the smart way, because there's a couple of things that tells you. You put that money to work, and if the borrowing rate's only 2%, what's the return on investment going to be? If it's in cash, it's going to be bugger all. So you can't put it into cash. Then what are the other options? Well, shares, and shares are a great asset, but shares are up and down at the moment, and that bull market is gone, man. It's a bear market, and it's not going to forget the bear market versus bull crap. It's that worked well, didn't it? The bull crap. I just noticed how well that actually sounded, how good that sounded. Now, in terms of where the market for shares is going to sit now and going forward, it's going to bounce. It's going to bounce up and down. You see in the communications we get every day, we get so much information in Elk. That's what we're about. We're processing so much information and pulling it apart and then rationaling and tying it against what our beliefs are and what our intellectual property is to go, well, wait a second, this is what we think it looks like. And so with that, we see people, the market's rallied and now it's down. It's also all the trading and all the big corporations, and there's people that make their money from that. That's what happens. And then sentiment changes and something shifts and all of a sudden it drops and it rallies again. And it's crap. It really is. So if we get away from that and try to avoid getting caught up in that, and my point on that asset of shares is, well, maybe the environment for a share kind of acquisition is best placed in the super environment in your world, where it's a long-term strategy as part of planning and saving for your retirement. And therefore that asset, shares, is certainly a long-term asset. So rather than borrowing to invest in shares in your personal world, or even maybe investing on a dollar cost averaging basis in shares makes sense in your personal world. But the problem is you've only got $10, $100, whatever it is per period. And there's only so much that money can do. And so you've got to try and grow your asset pool and get larger, lower cost core holdings in place to help get enough money invested in the market to access those open market forces. So perhaps then the other asset that's worth considering is property, direct residential property. Now, one reason for that is that with regards to acquiring assets, is it a better time to do it when markets are hot and everyone's just taking action and just paying whatever they need to? Sydney and Melbourne, that's a shout out to you guys. And I do expect that Sydney and Melbourne will have some adjustments to their property prices because they're well and truly over the $1 million mark, and they're certainly there to be corrected, or a movement that gets it more rational for the long term. I don't know how people can't see that. How can property price in Sydney and Melbourne continue to do and continue to drive forward? And I get it, it's a world-class city. I grew up in Sydney. It is amazing. There's nothing better than sitting in the opera house, in the opera bar on a Sunday, which I did with my family last year in winter, and just seeing that city, having a few of those Sydney Beer Company, I think it is, the brews they've got there, just beautiful. It's a world-class city. Population inflow, migration is it's one of its main drivers. But the thing is, that's going to slow. That's going to definitely slow what's happening at the moment. So even if that doesn't slow, how can it be sustainable to have properties that are so expensive? What are we going to have mortgages of $4 million in a decade? How are people ever going to pay that back? Because the incomes aren't rising like that, and the average earnings or the average property might be $1.5, $2 million. Well, how's an average person going to pay back that mortgage, and how much is that going to cost them? So there needs to be an adjustment there. But that doesn't necessarily mean it's going to shock wave through other locations, because other areas have been a slow and steady wins the race approach, or more steady growth. And certainly there's been growth in those locations that I'm talking about, but not as perhaps wild and free as the southern states have experienced. So what that means is, in purchasing an asset, is it a good time? And the thing is, I'm just going to make a comment here, that it's not about when you buy an asset, it's how long you hold it for. Especially if you get the asset for what it's worth when you buy it. So is it a good time to buy an asset when the market's running hot? Or is it a good time to buy an asset when the market is in a downward trajectory, when everything's negative, consumer sentiment's down, when you've got, and who do you think leads the charge in that situation? Bank valuers are the first one to lead the charge down when it comes to valuing assets, and the last one to go up when the market's running hot. So what that means is you got the opportunity to acquire an asset that you know has been scrutinized, that you know is worth what you've been asked to pay for it, or what the asking price is, because it's allowed for the market sentiment, the level of activity. It's taken into account short-term and medium-term movements in values to allow it to be sold, because if it didn't, then it would sit there and it would be acquired. And that's not what a property put for sale is there to achieve. It's there to be able to meet the market and get sold at an exchange that both parties are happy with, that then gets third-party checked and tested by banks and valuers to ensure, yeah, you know what, that's where it needs to be in terms of price. So I'd say that right now is a time where if you see moments for what they are, it's a time to look at acquiring assets to grow your asset pool. Of course, it means it's going to be done in a really tight kind of passageway where it gets squeezed through, and there's going to be gate openers and checks, and only what pops out at the end, well, if it pops out at the end indeed in any way, shape or form at all, it'll be what works for you, because it's had to go through that many different checks and satisfy that many criteria. Banks in the way that they process finance at the moment, valuers in their view towards assets, and then just being able to then get to the end result of, hey, look, I've got an approval and I'm now happy with it, and allowing to proceed on that basis. That's going to be a big tick. What it means is it allows you to put in place an asset that's worth what you paid for it, that's got a rental yield, because, and then if you go deeper into this, that if you look at where property valuations, the range, the property values are stacked. There are different markets. So property markets are not one total market. And so if there's going to be any pressure on property prices, it's going to start at the top, the high end, the top range, the stuff that's, the air's thin up there, you know what I mean? You need an oxygen mask to survive, 3 mil plus, and that's going to come down. There's going to be pressure on that. There is already. And then you're going to have the million plus. That's certainly where you're going to see that occurrence again. But if you're looking at an asset within a 400 to 550k price point, well, where does that go? There's some underpinning foundation under that, the price points of 300 and above, and even 250 for townhouses, etc. But for the equivalent of a house in that 400 to 550, there's not much movement because it's stacked. And what happens is, if people are going to need to adjust their living and their accommodation costs, they're going to drop down that level below. So it means then the people that drop into that 400 to 550, there's more of them. So there's more demand. So that's where you look for when you're considering an investment vehicle. You want to see those markets, those break up in terms of different price points to help protect the underlying value or the overall value of any particular region. That's one of the things that we look, or underlying value of a prime market area, for example. So we look for those sub-markets at 300, 350, 350 maybe 400, 400 to 500, 500 plus, 750 plus, a million plus, having that mix, not having all just in one price point. And if it is in one price point, depending on what that price point is, then that may lead to, that will, whatever the price point is, if it's a total saturated location with a certain price point, well, that may be affected depending on what's occurring in that location and what the price point is. But if the price point is in what I'm talking about, that 400 to 550, and therefore people are dropping into that price point as part of the property stack, then the impact may be very minimal indeed.